Most people think a vehicle purchase is transportation, a monthly payment, or maybe a financing decision. But financially, a vehicle purchase is much bigger than that. It is an accounting event, a net worth statement restructuring, a cash flow system change, a leverage decision, and a complete reconfiguration of the household operating system. And before the new vehicle can even enter the system, the old financial structure must first be unwound. So in this video, we're talking about the accounting entries, the amortization schedule, the depreciation system, and the financial statement impact behind a vehicle transition. But more importantly, we're going to examine how those accounting mechanics propagate through liquidity, leverage, survivability, and future optionality. Because accounting is not just record keeping, accounting is a map of how economic reality flows through the system. So before the old vehicle can be removed from the system, the accounting records must first be updated. This is critically important because accumulated depreciation is usually recorded periodically and may not yet reflect the current date of sale. If depreciation is not updated, book value becomes incorrect, gains and losses become distorted, and the financial statements lose accuracy. So the first step is to bring the depreciation system current. So in an example scenario, let's assume the original vehicle cost was $30,000 and the accumulated depreciation before current year is $18,000. The current year depreciation acquired up to the sale date is $2,000. So the updated accumulated depreciation is $20,000 and the net book value is $10,000. Inside the household operating system, we are using the one-row transaction structure, meaning every transaction is captured on a single line with a debit account, a credit account, and the amount and a description. And I would highly recommend going back and reviewing the season 1 and season 2 material to understand what's going on with the transactions. This creates traceability, automation capability, and structured propagation into the general ledger, the trial balance, adjusted trial balance, and financial statements. So the depreciation update appears as a debit to our depreciation expense account, a credit to our accumulated depreciation account, and the amount of $2,000. So this is just before the sale date. So what actually happened economically? The vehicle physically aged. Economic value was consumed. So expense rises, accumulated depreciation rises, and net book value, which is the difference between what the vehicle originally cost and the accumulated depreciation or the economic value consumed, that falls. Critically, no cash leaves the system. This is why depreciation reduces net income but is added back under cash flow from operations. That distinction becomes extremely important later. Now the old system must be unwound, and this is where the accounting becomes extremely interesting. Because the sale of the vehicle is actually a compound transaction, multiple things happen simultaneously. Cash enters, accumulated depreciation exits, the asset exits, and a gain or a loss emerges. This requires careful handling inside the one-row transaction framework. So in our example, the vehicle historical cost was $30,000. The accumulated depreciation is $20,000. The book value is $10,000, and let's say that the cash received from the buyer was $12,000. So what is actually happening here? The household receives cash, it removes the old asset, it removes the accumulated depreciation, and compares the proceeds against the remaining book value. The imbalance reveals either a gain or a loss. This is a very important accounting concept because gains and losses are not plug numbers. They are the residual economic outcome after the structure is unwound. So, in our one-row compound transaction structure, we would debit cash for 12,000 and we would credit the vehicle for 12,000. Okay? We would then take the accumulated depreciation. Now remember, accumulated depreciation normally has a credit balance. So to unwind that, we have to debit it. We're debiting it for the entire amount that is in that account. And we're crediting the vehicle. So that's $20,000. So notice here that we have cash from the vehicle for 12,000. We have vehicle for 20,000. So that equals 32,000. So there's actually too much in the against the vehicle because the vehicle is only worth 30,000 as the book value. So that results in having to debit the vehicle for 2,000, and the associated credit will be the gain on the sale for 2,000. Now that gain on sale is income, but because it's not operating income, we can either realize it in the income section of our income statement, or we can deal with it somewhere else. If we realize it in the income section, we have to make sure for forecasting purposes that we don't continue to forecast that gain on the sale of the asset, because that's not the normal situation that's happening within this household. So again, where is the gain? The remaining book value was 10,000, but the household received 12,000, meaning economic proceeds exceeded remaining carrying value. This excess becomes the gain on sale. Let's suppose that the opposite happened. Suppose that cash proceeds were only $8,000. Well, then the remaining imbalance would become a debit to loss on sale. This is critically important conceptually because credits represent value flowing into the system, debits represent value consumed by the system. Now let's look at the financial statement effects. Now the accounting propagates through the entire system. In each of the following financial statements, the following effect happens. So in the balance sheet, the vehicle is removed. In the balance sheet, cash increases. In the balance sheet, accumulated depreciation is removed. In the income statement, a gain or a loss is recognized. And in the cash flow statement, gain or a loss is removed from cash flows from operations under the indirect method. So we don't include that in that section there. Actually, the gain or the loss is going to show up in our investing section. This last point is extremely important because the gain itself is not operating cash flow and would otherwise distort cash flows from operations, or as we've been calling it, cash flows from lifestyle. So now the financial structure enters the system. And this is where many households misunderstand what actually occurs economically. Because the vehicle does not initially enter the system as an expense, it enters the system as an asset. That distinction is foundational accounting logic. The household has acquired a productive economic resource capable of generating future utility. So initially, the system recognizes an asset and a financing obligation, assuming that a car loan is used to finance the purchase. So suppose the household finances $45,000. The accounting entry becomes a debit to the cash for the $45,000 and a credit to a car loan payable for the same $45,000. What happened economically? The household's liquidity rises immediately, but leverage simultaneously rises. This is critically important because cash inflow alone does not mean the system became stronger. In fact, future structural pressure may have increased substantially. That's one of the most misunderstood concepts in finance. Now we move to the vehicle purchase entry. Now the vehicle itself enters the system. Under the one-row structure, we debit the vehicle asset account and we credit cash for the $45,000. So Keep in mind that the $45,000 comes into the bank account. Usually in the bank, they make a draft out for your bank account, and then they cut a draft for the vehicle purchased immediately. Why cash is credited? Because cash was deployed into a longer term productive asset. The household converted liquidity into transportation infrastructure. This is capital allocation. Now, the most important future pressure system begins the amortization schedule. The amortization schedule is not just a payment table. It is a map of future financial pressure through time, because every future payment contains interest expense, principal repayment, and cash flow consequences. So each payment contains a component of interest, which has an economic meaning of a cost of financing. It also has principal, and the economic meaning of this is the liability reduction. This distinction is critically important because they affect completely different areas of the financial statements. So, how does the payment affect the financial statement? Well, the income statement is affected by way of the interest expense. That rises. The net worth statement or the balance sheet, it is impacted because each payment reduces the loan liability. The cash flows from lifestyle or cash flows from operation equivalent is impacted by the interest payment. So we've decided that interest is going to be realized under the cash flow from lifestyle or operations section of the cash flow statement. Financing cash flow is recognized by way of the principal repayment. So in every time that we generate that cash flow statement, it reflects the period of time that principal repayment is made, and that shows up under the financing cash flow section. So notice that between the interest payments, which is a cash outflow, and the principal repayment, which is a cash outflow, both components of the loan payment are captured. They're just disentangled or dealt with individually. Okay. In the financing cash flow section, this is where the initial loan advance would be found. So when you go into the bank and you receive the cash for that loan, that will show up in the financing cash flow section as well. This is where accounting becomes systems engineering, because one payment propagates through multiple statements simultaneously. And you may ask why this matters. As interest expense rises, household flexibility declines, recurring obligations rise, and sensitivity to income shocks increases. If the car loan is a fixed interest structure, then recall that under the contribution income statement, that interest expense equivalent is going to show up under financing. So the degree of financial leverage is going to increase, and the total degree of combined leverage is also going to increase. That means leverage increases, there's greater sensitivity to shocks. This also directly connects to survivability and optionality.